Welcome to the Decentralized podcast, where we break down the world of Web3, digital assets, and DAOs with me, your host, Pietri Basson.
Andrew Knight, welcome to the Decentralized podcast. It's great to have you on. We've been working together with some of my clients on treasury management, and I thought it would be really good to come and have a conversation with you around that.
Yeah, thanks, Pietri. Good to be here.
Yeah, awesome. Well, I think the one thing a lot of people probably wonder is, how do you even get into treasury management and managing assets for people? What initially got you interested in it, and what was sort of your path? What did you study? How did you actually get into doing this work?
Sure. So like most people, I finished school not really knowing what to do with myself. And my family had always gone into finance and business. I was sort of taking a gap year after school to try to figure it all out. And about halfway through my gap year, I chose finance. Finance and economics is what I majored in undergrad. But still not really convinced that that was what I wanted to do. For something that I picked because it was sort of a safe option. And I only really started developing sort of a passion for it towards my final years, where I majored in finance and economics. And I particularly wanted to go down the investment management route. So after graduating, I started my CFA studies, Chartered Financial Analyst, and started working at the same time in the investment industry. That was a tough few years because you're having to work long hours and then still come home and study for hours and hours on your CFA. And back then it was only one exam a year. I think now they're doing several a year, so it takes a little bit quicker. So yeah, that was kind of my path into investment management. How I got into crypto treasury management is a longer story. I worked for several years in investment management in the TradFi industry, as they call it now, once you move over to crypto. Worked for several years. Then I really sort of got involved in crypto in 2017 on a personal capacity basis. Just doing trading, trying to figure it all out. What the hell is this new Bitcoin thing? And I think, obviously what attracted most people were the outsized gains that everyone was making. It roped a lot of people in. But at the same time, there were some companies that were, developing proper investment strategies around it, which is what I found interesting, especially as a young guy back then. You're kind of drawn to the riskier side of things.
Well, I think so. It's interesting because you've got that TradFi experience. So, I mean, I know you work with some really, traditional, very large managers as well.
Yeah.
What would you say are some of the lessons that you can almost take from that traditional experience? Risk management, hedging, all the stuff that I think crypto isn't that good at yet, and then apply, or what were some of the lessons you learned over there?
Yeah, so when you're building a portfolio, it's generally going to fall within one sort of a risk category. You're going to develop, your high risk funds or your low risk funds, and you're always sort of looking for sort of outsized risk adjusted returns in those spaces. So for instance, if you have a stable low risk fund, you could stick it in 2-year treasury bonds and earn your 3%, or you could enter into market neutral strategies and earn 12, 13, 14%. So it's really about looking at what opportunities are in the market given a certain risk profile, and diversifying the portfolio across a range of these strategies. I think that's incredibly important. And then for indexing as well, there's been a lot of studies on how active managers, after you account for your 20% performance fee and your 2% management fee, they're not really, the vast majority of them aren't outperforming just a standard index fund like the S&P. So indexing is what I found quite interesting. And we found, quite a few years ago, the big players in the industry like Vanguard really start to accumulate a lot of AUM, whereas before it was very much centered around active managers. All the marketing and hoorah that goes around there, hedge fund industry in America. And yeah, that's we can get into it later, but that's ultimately what we got into in crypto as well, indexing. Yeah.
Well, I mean, you sort of led into my next question there, is you mentioned that then you went from the traditional finance into the crypto side. So what was your first dip of your toes into the crypto industry, and what did you work on?
Yeah, so 2017, as I mentioned, is when I started following crypto. I knew someone that was looking to launch an index fund. They had launched it in 2017, and they were looking to launch a range of other funds. This is right when the whole ICO boom was happening. So there's a lot of capital flowing around. Startups were raising a ton of money. A lot of risky stuff in the market as well, as we saw in the later years. But this I thought was quite interesting, given my background in investment management and a company launching actual tokenized funds. I thought that I could add some value there, given that the guys launching these products are mostly technical guys, very smart devs, but didn't have the asset management experience, especially given the sort of subsector that they were in crypto. So I jumped ship out of TradFi and moved into crypto beginning of 2018. Initially, mostly to invest in startups. So we had a VC fund investing in top ICOs of the time. And I don't know if you remember the market back then, but ICOs were big in 2017 and early 2018. And then you saw a big downturn towards the tail end of 2018. So we had to change the strategy quite quickly. We had raised about $10 or $11 million for the fund. And the strategy of the fund was to invest in ICOs. ICOs came to an abrupt end and ultimately hurt the market a lot in the following years. But yeah, we pivoted into equity-only investments. Obviously, there's far more protections in place when you invest in equity. The attraction of ICOs, obviously, is the quick sort of turnaround time. You can fund an ICO. 3 months later, you can get secondary market liquidity, and then you can just kind of recycle that. The reality was that a lot of these projects didn't have any real product market fit. They were really good at marketing, but when it came to actually utilizing these tokens, there wasn't too much value, and the market quickly picked up on that, I think. So yeah, that's ultimately how I got into crypto, and that's where I started.
Okay, and then working with those, especially the VC investments, what were some of the mistakes that you saw teams making a lot of the time? Either, well, we're going to talk treasury management, but maybe more generally as well with the products that they were launching.
Yeah, so a lot of the projects, once they release their token, they get secondary market liquidity. They're sitting on quite a large market cap, and the treasury that they hold is all in their native token. So we had projects that would launch. They would, have $50 million in token value. And obviously, as the founder of those projects, you want to have conviction in your project. So you don't want to go and sell that token and signal to the market that you don't back your project. But I think that's not a mature way of thinking about it. If you were running a company and you got a traditional company and you got a whole lot of VC funding and you put all your capital into an incredibly high risk asset, no one would be happy, especially the minority investors. So that mindset, I think, was a big mistake. It still is. I think it's really important that these crypto projects, when they have the ability to, they need to at least build up 18 months, 24 months worth of runway in stables. Because as we've seen, when the market does turn, and in 2018, this is exactly what happened with projects, the market turns, your token all of a sudden has got no secondary market liquidity, and you can't meet your OPEX. So the projects fold, and then there's no coming back. So that's definitely a mistake, and something that projects even today should really consider.
No, I mean, I think we've all seen that as projects where they've got a lot of their own token. They think it's going really well. The market turns, and then there's not a lot of liquidity. They can't really sell it. They might still have a really good idea, but they can't actually operate and run with that idea. Sort of after the VC side, what did you do after that then?
So we started launching a range of open-ended tokenized funds, all different strategies, market neutral, indexing, a couple of option strategies as well. And you really start to get, over different cycles, you get to feel out the different ebbs and flows. One thing that we didn't have back then was very good tooling. So we operated on exchanges and some DeFi protocols, but really to track a fund back then was tough. The tooling these days, you can just plug in your wallet addresses that you're deploying capital from, perfectly tracks it across all the different dApps, spits out really great P&L and all sorts of other metrics that you need. Back then, there was none of that. Everything was built in-house. So there are a lot of challenges.
So yeah, I think the tooling is something I remember. I mean, in the good old days, I especially remember my KPMG days, it wasn't as easy as just plug it in, getting the information, all of the blockchains were different, etc. So yeah, I remember the good old days. It wasn't as easy as it is now. It's definitely much easier now, and you can do much more robust tracking. I think the other thing that a lot of people back then didn't realize is all the different risks that you were exposed to. So I mean, you had first-hand experience. What were some of the main risks that you were seeing back then?
So apart from the sort of normal market risk that you're exposed to in crypto, given the extreme volatility of the asset, there's a lot of operational risk that you're exposed to as well. The fact that you're dealing with hardware wallets, private keys, who's maintaining these, the fact that if you send a transaction off, there's no getting it back. These sort of things don't exist in the traditional space, and there's a huge amount of risk attached to that, especially when you've got millions of dollars on the line with any single transaction. So there's operational risk, but there's obviously counterparty risk as well. So counterparty in terms of your traditional institutions, and then also your more sort of technological risk or protocol risk. So we saw a lot of that in 2022, for instance. The protocol risk being UST and the whole Terra ecosystem, and your counterparty risk, like your Three Arrows Capital, your FTX, Celsius. There's a whole range of them. These risks are very difficult to forecast, and much like the 2008 financial crisis that occurred off the back of collateralized debt obligations, mortgage-backed securities, really new securities. That the risk was quite difficult to calculate. So people sort of underestimated it, and as devastating as these things are when they come down, what happens afterwards is certain protections are put in place to make sure that these things don't happen again. So it really strengthens the market. As much pain as everyone goes through when these things happen, the managers, the investors, everyone involved, and the trust that gets lost, it's devastating. But following that, we've seen, for instance, now exchanges giving proof of reserves where before they never did anything like that. It's become, the standard to be transparent in the industry, and risk management has really sort of taken a step forward since then.
Mm-hmm. No, definitely. I think we've matured a lot. That's one of the reasons why, I contacted you, why we've been working together, is you've had a lot of experience. I think when you come from seeing where things were and then you're operating it now, you've got a much better understanding.
Yeah.
So that might be a good segue into what you're working on at the moment. So I think I was working with a few foundations and DAOs. We realized that their treasuries weren't really being managed, either on the token side, but also on the stablecoin side.
Yeah.
So can you give us a little bit of an overview? What are you doing at the moment, sort of for teams, and how are you working with them?
Sure. Yeah. So as you mentioned, we've moved into the sort of DAO Treasury Management space, which is fundamentally it's very similar to traditional treasury management for companies. If you think about a DAO, it's a decentralized organization, but still one that generates revenue or cash flow in its native token. It has real world expenses through its foundation companies. And it's got a certain runway in its native token. Okay, that native token though is incredibly volatile, and it's usually highly concentrated in the DAO. So it's very difficult to forecast the future value of that token. It's difficult to forecast what you're going to be able to liquidate it at. And especially when these DAOs launch, the protocols are in no way sort of profitable. This takes quite a long time usually, but there's very high overheads initially. So apart from all of your setup costs and your marketing costs, you've got your directors' fees, your legal fees, admin fees, and these all, are quite significant costs. The last thing you want, and I'm talking especially here around sort of mid-sized DAOs, is to have situations where at any given point you only have 2 months worth of runway in stable assets, liquid stable assets, to service all these expenses. And then you go through a bear market. Because, the big DAOs, like the Uniswaps of the world, if their multi-billion-dollar treasury goes to $1 billion, they're going to be fine. They're going to be able to weather a bear market. They're going to meet their OPEX. The smaller guys, the secondary market liquidity dries up. It's very difficult to liquidate their native token. And it can create sort of a compounding effect as well. If the community or the token holders see what's happening and sees all the liquidations happening from the DAO, they don't want to hold on to their token either anymore. So it creates this kind of compounding effect, and the token ultimately just gets destroyed. So when times are good, that's difficult to know when it's good, but you ultimately want to be putting a financial plan in place to diversify the treasury to at least have 18 to 24 months worth of runway.
So I think it's very true. If the token price is down and the DAO has to sell, that's not a very good position. And the token holders will also then start selling. I think one of the things that's been interesting when working with you is when you create a financial plan for our clients and sort of sit with them and go through everything. So what are you normally looking at when you're doing that financial plan? And sort of what are you planning for? What are you trying to adjust for?
Sure. So the first thing you've got to do is look at the existing makeup of the treasury of the DAO. How much of it is sitting in the native token? What total percentage of circulating supply is held by the DAO? What is the volume? What is the secondary market liquidity? If you did want to sell, how much could the market absorb safely? And then you also want to assess how much revenue is this protocol bringing in. So for instance, if we use Uniswap as an example, the protocol generates fees through trading. So that's all revenue coming into the DAO. And obviously every DAO is different, every protocol is different, they generate revenue in different ways. But then you also want to look at the expenses that they're incurring. And we're talking about the real world expenses here, your director fees on the legal entities that are set up, marketing costs, grants, admin fees, legal fees. Depending on how complex these structures are, they can be significant amounts. So you don't want to be in a situation where you're liquidating tokens on a monthly basis to service this. So before assessing how we're going to diversify the treasury, these are the sort of things we look at. We look at what's coming in, what's going out, what's the current makeup, but then also the community needs as well. So it's ultimately the DAO treasury is controlled by the token holders. You can go and make proposals to the token holders to diversify the treasury, but ultimately it's going to come down to their vote. So you would need to put together a plan or a budget on how, if you are going to sell out of the native token, how are you going to go about doing it without creating some sort of negative market impact? Over what time period are you going to be doing this? And then once it is sold, what assets are you going to be deploying these stables into? And this is really just the stable portion of the portfolio, which is, as I mentioned earlier, your 18 to 24 months worth of runway that you want to hold at any given point.
So I think, that stable treasury is actually what's really interesting. So once you've sold and you've got that stable treasury, what are you normally looking at investing in, and how do you diversify that? Because I'm guessing that you try and diversify that across a few different places so you don't have risk in any one spot.
Yeah. So the stable allocation it's usually transferred into one of the legal entities, whether it's a foundation company or some other structure, because every DAO needs to have a legal entity that's set up to engage in real world transactions. So generally the runway or the stables will be transferred there. The nice thing about a legal entity is that you can open up bank accounts, you can open up brokerage accounts, you can invest in anything really that the directors approve. Most of the participants in any particular DAO want to see all assets on chain, and rightfully so. You don't want assets disappearing into a black box and trusting someone involved with the DAO to maintain or report on these assets. What's great now is that a lot of real world assets have come out on chain. So of course we've seen the BlackRock Biddle Fund, which is gathering a huge amount of AUM. That's safe treasuries on chain. We've got other big asset managers like Franklin Templeton doing the same now. There's a whole host of them, Mountain Protocol. So there are these safe options, which were great as well when yields were quite high in the treasuries. I think, with the rate cutting cycle now coming down, you're going to be looking more in the sort of 3% range pretty soon. But then, of course, on chain, there's a lot of strategies that are relatively low risk. You've got your over collateralized lending. You've got various market neutral strategies as well. So there's really a sort of range of, and of course, adding liquidity to AMMs, stable coin liquidity. There's a lot of strategies. It really depends on how much size you're looking to invest. If it's millions of dollars, obviously you'd rather go with safer options like your tokenized mutual funds. If it's smaller allocations, you can add liquidity to certain pools, lend on an over-collateralized basis. All of these are ways of generating relatively low risk yield.
Mm-hmm.
Yeah.
Awesome. And then you mentioned the protocol token, because sometimes the foundation is holding quite a bit of protocol token as well. What can you do with that protocol token? Can you use that to stimulate the sort of economy of that specific chain or protocol as well?
Sure. It really depends on what it is they're doing, what the protocol does. A lot of DAOs use the native token to they add it to pools to create more liquidity for that token. You can lend it to market makers to create more liquidity on centralized exchanges. You can also use it for grants programs. So any protocol that you launch, of course, you want to generate or garner more users. So you want to sort of reinvest in your protocol. So a lot of them are using them for grants programs. There are a whole different sort of host of ways that you can use the native token to generate yield or put it to work. if you try to draw contrast to a traditional company, it's really about reinvesting in the business, so you can earn a whole lot of revenue from the product or service that you do, and then using that money, instead of spending it on frivolous things, you go and reinvest in the company itself. And that's exactly what you can do with the native token.
Awesome. I think then with sort of what you're doing specifically, I think there were two things that were interesting from working with you. I know that you're a little bit different than some of the other solutions that I've seen in terms of you guys having a sort of regulated license, doing non-custodial holding of these assets and recommendations to everyone. Can you maybe talk a little bit about how the solution that you provide is different than some of the other things that you see out there in the market?
Sure. So currently there are guys doing treasury management for DAOs. You need to draw a line between the DAO assets though and the legal entity of the DAO. As I mentioned earlier, often it's a foundation, but it could be another entity. If you're managing assets for the DAO, because you're not engaging with any legal entity per se, you don't need to necessarily be a regulated manager. You'll put your proposal together and post it on the governance forums. The token holders will review it, and if they agree, they'll let you manage a portion of the treasury within certain parameters. If you want to manage assets for a legal entity, you need to be a regulated investment manager. So really, we ultimately want to be putting in diversification strategies, migrating assets from the DAO into the foundation to make sure that they have enough runway to weather market downturns. So we domiciled ourselves in the British Virgin Islands, and we've got an investment manager license there. And that allows us to legally engage with the legal entities that are set up behind these DAOs. We, of course, obviously have to abide by all the reporting requirements, regulatory requirements, which gives us a lot of sort of substance, as opposed to some of these other guys that are sort of DeFi traders that are participating in DAO Treasury Management.
I think, and that's one of the things that gave me a lot of comfort working with sort of the team and working with you, is I knew that you had that regulatory responsibility.
Yes.
There's a regulator behind you. There's a certain standard that you have to hold yourself to when working with clients. And that definitely gave us a lot more comfort. And this is some of the questions you ask sort of as a director when you're looking at different service providers.
Right.
I think the other thing that gave us a lot of comfort is the fact that it was a non-custodial solution. So you're not taking these assets and sending them all to a hedge fund. And when you're doing a transparency report, half of the assets are not even held in the foundation anymore. How do you manage the non-custodial side of things?
So as I mentioned earlier, whether the assets are in the legal entity or in the DAO, the community generally wants to make sure that they're fully on-chain and transparent, and rightfully so. What we do is, if we are engaged by the DAO's entity, we will set up an MPC wallet solution, fully non-custodial. So on the MPC wallet, you'll have certain individuals with admin rights, and then you can set signing rights for others. So in this case, we'll set up a wallet. We usually use Utila, but there's Fireblocks. There's a whole lot of service providers out there, and they're getting quite advanced in what they can do. And then we'll get the directors of the foundation or whatever legal entity it is, or people from the Security Council of the DAO to be the majority of the signers, or the admin. They'll make up the admin quorum. So what that means is they ultimately control the wallet, they control the security keys, and they control any policies that get put on that wallet. So the nice thing about MPC wallets is that you can create very granular rules on these wallets, meaning you can only give initiation rights, transaction initiation rights to a third party like us, for instance. So what we can do is we can initiate transactions, and they can say whether we can or cannot release those transactions or not. You can also whitelist certain protocols or dApps that you want to interact with. So if we wanted to, for instance, allocate assets to lending in Aave. We couldn't do that unless the DAO's admin quorum has previously already allowed us to do that, which really sort of, if you engage with an investment manager like us, the rules or the parameters in which you can manage assets are already set. We can't go outside of those bounds, which is great for the community as well, because they don't want to hand over full control of a large portion of the DAO assets to a third party, because ultimately it is the DAOs or the token holders' assets.
Yeah, no, and that's great that you have that plan, you've got the structure, and I have to say, working with technology, it's very, very reassuring and very good. I mean, there's lots of good security there. It's really easy to manage, and you can easily move assets even as the foundation. If there's a position, we can close it completely independently. I think the other thing, especially with treasury management, is risk management. So how do you sort of look at the risk management, look at the different protocols you're invested in, monitor them?
Yeah. So as I mentioned earlier, like back in 2017, 2018, there's absolutely no tooling for portfolio management, and there's basically no DeFi back then either, actually. Now there's incredible sort of risk management guys in the industry like Hexagate, Hypernative, that have got incredible tooling that can plug straight into MPC wallets, like your Fireblocks, like your Tiller. So what you can do is you can set up your positions. You can set certain alerts for various things, like if there's a suspicious contract deployed, if there's a depegging event, if there's sudden spikes in liquidity or changes in wallet balances, you can get alerts. But you can actually also now get integrations with those MPC wallets where you can auto unwind positions. So if there is some sort of depegging event or exploitation, you can have transactions already pre-lined up to unwind out of certain DeFi positions. So it just means that you don't have to wait for multiple signers to unwind, which can generally take quite a while. This can all happen autonomously.
Yeah, and I mean, I've sat on multiple multi-sigs, and that was one of my concerns when we were sort of considering treasury management, who's going to be doing this, is, do you have to wake someone up at 2 a.m. to liquidate this position? And that's the thing that, I mean, also made me very comfortable here, is the fact that you have automated tools, MPC wallets, you can actually integrate them and set those very specific rules.
Exactly.
Which, I mean, everyone sleeps much better at night just because of that. The next thing that I wanted to get into is sort of a different service that you've provided. We've worked with one of our clients on this, and this is token sales for team members.
Yes.
Where we had a team member that had a big token allocation, and you were sort of helping them to sell those tokens. Can you maybe get into sort of team member token sales, why that's a good idea, and what you do there?
Yeah, so this is an interesting one. A lot of projects, most projects, they incentivize the initial founders through token allocations. If the project becomes really big, often these portions are quite huge, and it's not something that you can sell off in one single go. They usually have vesting schedules over a couple of years, but even on a monthly basis, the amount of tokens that are vested are considerable. If every team member had to go sell, you're going to have negative market impact. But also the token holders of the community are watching these team token wallets. And if you see the founder of a project selling down large portions of tokens, it's not good for optics in the market. They feel like the founder doesn't have conviction. Sure, it's okay to sell a small amount, but if they're selling all of their tokens every single month, it's not great optics. And there's also a lot of team members that aren't necessarily traders. They don't know how to trade. And also handing over a huge amount to a single market maker or OTC desk, you're not really necessarily getting the best price. You don't know whether the price they're executing on is actually the legitimate price that they're getting in the market. So a couple of projects are now reaching out saying they want independent third-party token sales, where the team tokens are handed over to an investment manager who's able to manage these assets, and then make strategic sales throughout the course of the year or 2 years, however long it is, but also getting the best pricing from multiple OTC desks or exchanges. And this is good for optics because no trading takes place on material non-public information. If the community or the public know that all these token sales are taking place by an independent third party and not by the founders or team members, they know that these tokens are just getting sold off according to a plan, completely blind by the investment manager. So it helps the team members by not having to go through the admin of actually making the sales. You've got a professional investment manager actually making the sales at opportune times, obviously doing sort of a DCA strategy, getting a time-weighted average price. And it has less of a market impact as well. If you get some of these traders that are all selling huge amounts, we're talking millions of dollars instantaneously into the market, that's not good for token price either.
I'd agree. I think it was a really interesting one when we sort of had someone ask for that. You were able to provide the solution because it's good for the project because it's completely independent. There's no, public insider trading or anything risks like that. And also, I mean, as you say, some of these guys are developers. They're not traders themselves. So it's better for someone professionally to do that. If we maybe then get into some of your other services, I know you're not only focusing on the foundations. So what are some of the other services that you're looking to offer and some of the targets that you're working with there?
So, I mean, if you look at DAO Treasury Management or Foundation Treasury Management, it's very similar to sort of a managed account, if you will, in the traditional space, because we don't have custody of the assets, and the investment plan or strategy is very much overseen by your client. So you're abiding by a particular plan. So given that, you can take exactly what we're doing on-chain treasury management into the traditional space. So if you've seen recently, there's a huge amount of hedge funds and family offices now wanting exposure to crypto assets. And I think the fact that, Bitcoin and ETH have had their ETFs launch, you've got BlackRock's Larry Fink busy marketing crypto now on the mainstream. It's really sort of legitimized the space. So there's a lot of traditional funds that are wanting to get exposure. They'll carve out, 5, 10%, 2% of their portfolio to get some sort of diversified exposure to crypto. But they also want to maintain custody and control of these assets. Hedge funds as well. Hedge funds and family offices, same thing. So we can go and set up these MPC wallet structures for them, get them onto the admin quorum, show them exactly how it all works, and then also design various different strategies, whether it's stable strategies or direct crypto exposure. We can manage that process for them in setting it up, giving them qualified custody if they want as well. So it doesn't have to just be like a typical Fireblocks or Utila MPC. It can be held in a qualified custodian like BitGo or Anchorage. It's just that they generally have experience in the traditional space, and the thought of trying to set up MPC wallets in crypto when they've never worked with crypto before is just beyond a lot of them. So we really sort of run those services, helping family offices and hedge funds set these structures up and then manage whatever strategy it is that they're wanting.
Awesome. No, I think that's really exciting. It's exciting. I can think if you're a family office, you don't have the experience. But you're not taking that counterparty risk, giving all of your assets over to someone. You still have control over the assets. You just have someone professionally managing them. So I think that's a really good solution. Maybe to wrap things up, we usually get into 2 questions. So first thing is, what are you excited about at the moment in the industry?
There's a lot happening in the market at the moment. The great thing is that, on a yearly basis, the more capital that's flowing into the space, the more intellectual capital is coming in. There's a huge amount of really smart people in the space, and they're building tooling, projects, infrastructure all the time So to watch it evolve from where we were in 2017 has been incredible. The fact that we've got sort of more sturdy regulation now around the space is also fantastic, because I think there are a lot of people sitting on the sidelines purely because it was a bit of a gray area. They didn't know sort of in which parameters they could, dip their toes, if you will. So all of that is kind of slowly getting built up now, and it's exciting to see. The fact that we've got our ETFs approved now is fantastic. And the space is just not slowing down. I don't know if you remember, like 2017, 2018, everyone was calling it tulip mania. And we've seen cycle and cycle again now that it's just getting bigger and bigger, the space. I'm excited to see what the future holds.
Yeah, I think the maturization and the growth has been really good to see in the whole industry. And not to only focus on the positive, what are you cautious about, or what worries you in the industry at the moment?
Yeah, look, there's always a lot of cowboys in the space. Anyone can launch a token on chain. Anyone can launch a marketing campaign around a token. So you're always going to have those guys in the industry that are trying to take advantage. They don't have the best interests in mind when it comes to launching some of these projects. So you're always going to see these sort of scammy rug pulls, people that bring the space down. It's difficult to steer away from that, just purely given the sort of inherent nature of crypto. People like to take risk in crypto. It's what draws a lot of them into it. The potential to make outsized returns, but at the same time you can lose a lot. So it's important that people just are aware of that. There are going to be people out there that try, take your money. So don't take too much risk.
No, I think the crypto industry doesn't have great track record with risk management. I think as we mature, we'll get there. But it's also human nature. People love to, take that risk. So I don't think it's going to go away soon either, unfortunately. Well, so Andrew, great to have you on. We'll put all of your contact details down in the comments. Really appreciate you coming on, and look forward to working with you on different clients.
Thanks, Petri. Awesome. Good to be here.
Thank you for listening to the Decentralized podcast. I hope you enjoyed this episode, and would really appreciate if you could like and share if you got any value from this episode. Please also make sure you follow us on YouTube or wherever you're listening to your podcast to make sure you don't miss the following episodes. If you want to connect with me, you can connect with me on LinkedIn or Twitter. We've got the links down in the description. And I'd also like to thank our partner for this episode, Hash Directors. Hash provides independent directors to Cayman Islands-based digital asset funds, foundations, as well as BVI entities. And the team over at Hash are really experienced. They can make sure that you consider all of the different things that you need to look at when setting up a company. They really know their governance as well as regulatory compliance. If you want to learn more about Hash Directors, there's a link down in the description. I'll see you on the next episode.